a lot of Americans who kind of live on the edge, they play financial budgetary catch up when they get their tax refund. But now the government has changed the law. And if you're not repaying your student loans, they can come in and take all of that tax refund and just put it into the government's coffers. What we're seeing right now, what Walmart and Target and the largest essentials retailers are telling us is, if it's not on super discount and it's not groceries or pharmaceuticals, they're not buying it. We have this gigantic mortgage market in the United States, the biggest debt market in the world. And what we're seeing is a lot of individuals who may have bought homes as investments in the pandemic and hope to rent them out, they're running out of leeway to get refinancing. You just need for these older individuals who cannot rejoin the workforce to begin to sell their stock together. And then you will indeed start to see the momentum trade turn in the risky asset markets. I think now is a good time to be hedged. I don't say that, I laugh when I say it, but now is definitely a good time to be planning for, what happens if the momentum trade does turn.
Hi, everybody. Welcome back to Reinvent Money with me, Paul Buitink. I'm really happy with today's guest, former Fed insider Danielle DiMartino Booth, who is now CEO of QE Research and wrote the book Fed Up, an insider's take on why the Fed is bad for America. I'm going to talk about the Fed and central bank policy in general with her. We'll also discuss the American economy, a looming subprime crisis, and whether France is getting a bailout. Hi, Danielle. Welcome to the show.
Thank you for having me. Lots to talk about, clearly.
Yeah, you got some hot numbers coming in. The ink isn't even dry yet, but it also ties in with that, my first question, because last time the US was officially in a recession was during the COVID crisis in 2020. In 22, we saw 2 quarters of negative growth, but it wasn't called officially a recession. Are we at the moment in or close to recession, you think? And what kind of data are you looking at?
So I think what we have to bear in mind is that forcibly closing an economy and reopening it by edict of law really did introduce a lot of noise into the official data. If we look back further beyond, again, kind of the 2-month quote unquote recession around COVID and look at that June 2025 negative print, because it was revised all the way into the negative with the most recent payrolls data, that June 2025 is the first time that we've seen a negative number since September of 2010. So we really have been in an overgrown expansion for some time. I'm going to talk out of the other side of my mouth, which will show you that I used to work at a central bank, and say that at the same time, there's a lot of focus right now on what we call annual benchmark revisions. Now, those are only released, for example, in September the 9th, 2025, we will see data that reflect back on the year ended March of 2025. So that's how long we take to get actual annual revisions. When we incorporate them, it looks like the first, and this is based on 12 million US employers. And that's what's really important here, is that you're talking about hard data instead of a lot of the reasons that the Bureau of Labor Statistics has come under criticism. And that is that there's a lot of imputations, a lot of guesswork with how they come up with the monthly payrolls data. But if you look back at that data, net job destruction began in the second quarter of 2024. And I think that's what's really critical, is that we actually have job losses that began more than a year ago. The mystery of the US presidential election is much less so when you consider that people were already losing their jobs headed into that presidential election. They were voting for change because despite what was in the headlines, they were experiencing job loss on the ground. And they were feeling recession, and that's how they voted on voting day. And so that's you have to keep perspective, because some of these annual revisions are to the tune of negative 800,000 over the period of the prior year in question. And those are huge swings when you consider, that we've had 29,000 jobs created in the last 3 months in the US economy, according to current data. That doesn't even keep up with the size of the growth in terms of people entering the workforce. So we're in a continuing recession. It looks like we might have had a little blip of confidence around the actual election, but it looks like we fell right back in the first quarter of 2025. So I think perspective is really important here. A lot of people in your world and mine are focused on the very short term, but this has been going on for quite some time.
Is there anything Trump can do about it?
Well, right now, I think the most important thing is continuing to the best of the administration's ability to get rid of the uncertainty factor. One company after another is saying we're either not investing, we're not making capital investment, we have a hiring freeze on, we're not expanding our workforce, we're not hiring employees because we don't know how to plan for business a week from now, much less 6 months or a year from now. So it's that huge uncertainty weight on the economy that I think that the Trump administration has the greatest chance of really distilling. A lot of this has been caused by tariffs, of course.
Yeah, so removing uncertainty would also imply removing some of these tariffs, or at least provide certainty when it comes to those tariffs. So not flip-flopping, but be resolute about it.
Yes, one way or another, just so that companies can plan. And again, this is an economy where we're seeing by the end of September, we're going to see hundreds of thousands of federal employees run out of the severance that they had. We forget about DOGE, the Department of Government Efficiency, but it was efficient enough that a lot of federal government employees are going to be running through their severance at the end of September, at the end of this month. And that they're going to be added to the ranks of Americans looking for work right now. So it's the past few years have been punctuated by, the private sector's falling down, but we can rely on the government sector to make up for that with hiring. Even what we call recession-proof industries, healthcare, even those industries are starting to see real weakness. So again, if I was to be advising the Trump administration right now, I would say the hope for the future lies with the private sector. And to engage and re-engage the private sector, you're going to have to figure some of this uncertainty factor out so that they can begin to plan and rehire.
Right. And I also saw that student loan delinquencies have also risen from like 10% in 2019 to almost 20% now. What does that tell you?
Well, what that tells you is it gives a lot of reason for why we've seen funny charts running around that show that AI investment, artificial intelligence investment, has now surpassed that of consumption's contribution to GDP. You don't see charts like that every day. It's not normal because the United States economy is 70% consumption. So to see consumption declining to the extent that it is, just as student loan repayments are kicking in, tells you that that great engine of economic growth, the U.S. consumer, is stumbling, and that they're going to continue to stumble all the way into and through tax refund season. A lot of people who are delinquent, as you say, we've seen these numbers rise appreciably. They're not paying their student loans. They don't have money to pay their student loans, but you know what? They're going to be relying on that tax refund in February.
Yeah. It's also quite harsh to realize that you spend like a few $100,000 on some education, and then only to be replaced by AI. It's just,
and that's that is the insult to injury, if you will. But the reason I bring up tax refund season is a lot of Americans who kind of live on the edge. They play financial budgetary catch up when they get their tax refund, but now the government has changed the law. And if you're not repaying your student loans, they can come in and take all of that tax refund and just put it into the government's coffers. So what I'm saying is there's going to be a lot of stumbling blocks for consumption.
Yeah, and they're probably also going to use credit cards. So you'll probably also see credit card delinquencies rise because they're trying to fill one hole with the other then.
That's exactly right. And to your point, We have seen whether it's automobile delinquencies. I bought more car than I could afford. I never thought I'd have to pay my student loans back, or I'm subsidizing my income by using my credit cards. And indeed, those delinquencies are almost at the highest levels that we saw coming out of the Great Recession already.
Yeah, and within the FinTwit sphere, you also read quite a bit about a potential for a new subprime crisis, or at least some nasty things happening in the real estate market in the US. Like I live in the Netherlands, in Europe, and there's still house prices are still going through the roof. Also because we're a small country with a lot of people trying to find a home, and there's just a shortage of houses. In the US, of course, there's much more land, but what does the housing situation look like in the US at the moment?
Well, the more you have the compounding effects of student loan delinquencies, credit card delinquencies, um, automobiles, the harder it is for people to gain access to financing of any kind. And we have this gigantic mortgage market in the United States, the biggest debt market in the world. And what we're seeing is a lot of individuals who may have bought homes as investments in the pandemic and hope to rent them out, they're running out of leeway to get refinancing. And mortgage lending standards are clamping down. You have the median age of baby boomers, you're talking about 76, 77 million Americans. They own more home than they need. And yet we've had, the birth rate in the United States come down so much that there's a generation of individuals, the millennials, they don't need to buy the baby boomers great big gigantic homes. They may only have one child. They may not even be married yet. So there are a lot of different pressure points right now for the US housing market. We've just seen in fresh Redfin data, second home sales, sales in vacation areas, those have fallen to the lowest levels in Redfin's records. So you don't have all of these extra sources of support that you had for the housing market. Foreign buyers aren't coming into our market anymore either. So it's one thing after another. So to the extent that you are what we call an FHA borrower, somebody who used government assisted financing to squeeze into a home, and you're a subprime mortgage borrower, yes, that was a really long answer to your question, but yes, you could be running into more financial challenges and distress here going
Yeah.
forward.
And I read Scott Bessent also worries about this. What can he do? Or what can the US do in order to avoid this bust from happening?
Well, they've talked about declaring a national housing emergency. And, one of the only things that you could theoretically do to prevent another wave of foreclosures for those who can afford their homes the least, or they have the lowest ability to make that mortgage payment, is just to call another moratorium on foreclosing on homes. And we've just now gotten past that chapter to where we're back to having a more normal mortgage market where you are going to lose your home if you cannot afford to pay for it. So Bessent would be effectively bringing back a lot of the programs that were criticized under the Biden administration. There's some irony there.
Yeah, I can imagine that. So, given all this, it seems likely that the Fed, when they meet at the FOMC meeting, 16 and 17 of September, it's very likely. I think markets are expecting that it will cut rates. Do you expect them to cut with 50 basis points or 25?
So our call at the beginning of 2025 was that we would see 4 rate cuts in the year 2025 total. And I do have concerns that we're recording this less than 24 hours before the annual benchmark revisions come out to payrolls. If they're as bad as what most of the biggest banks, Wells Fargo, Bank of America, if the revisions on the annual level are as bad as we think they're going to be, then you could easily see the debate shift more towards 50 basis points. But by the time September the 17th rolls around, again, with just the very short term revisions that we have in hand, we know that the private sector hasn't cranked out any jobs since May. So individuals like Christopher Waller, who is in the running to replace Jerome Powell as chair, when his chair term expires in May of 2026, individuals like Christopher Waller are going to find a louder voice and say, you know what, we should have been lowering rates in May, June, and July. We're not just talking about one little mistake that was made in July. We should have been lowering rates all headed into the summer, and we need to really play catch up there. And that's why you're seeing the market begin to price in the probability of a half a point rate cut as early as September. We're even calling for another potential one with our clients. We put that out this morning. We're calling for another potential half point cut at the October meeting.
Wow. Okay. So then maybe Trump will love Powell again. He will not be Mr. Too Late anymore. He will be Mr. Right. Or you don't think the love will come back?
Well, I think that's a great big word, given the criticism that's been hurled. I was out of the country when the now infamous tour of the Federal Reserve building construction was going on. And,
That was hilarious for me as a foreigner to see that. I was just like, it's just ridiculous.
well, the foreign press covered it like it was a cartoon.
Yeah.
And that's kind of what it felt like being overseas at the time. It was really to suggest there's love on the way is a bit of a high order.
Yeah. So, I mean, you would expect then the stock markets to also correct. We have these ridiculously high valuations. But I talked to, maybe you know him, Henrik Zeeberg, the other day. He's an economist working for Swissblog. He expects a bust, but he still first see the next 6 months or so. He expects more FOMO buying, more momentum trading, and also on the basis of potential rate cuts, more liquidity offered by central banks. He expects for the next 6 months or so for stock markets and crypto markets to keep on rising. What's your short-term outlook on the stock market, for example, in
So
the
I
US?
think, and this is something that I've been pretty public about, turning the momentum is enormous. And if you're going to turn momentum, I think we have to have enough of a loss of interest income. And I'm talking about retirees here. So retirees in the United States own more than 50% of the stock market. So let's just say that there is a half a point cut on September the 17th. Are they going to say, oh my gosh, I'm not earning 4.25% on my cash anymore. I'm earning 3.75% on my cash. No, I think they'll sit tight. But if you start to talk about 100 basis points or 150 basis points, as Scott Bessent has said would be the appropriate level of rate cuts, then you're going to start to wake the beast of retirees. Individuals over the age of 70 own 40% of the US stock market. You just need for these older individuals who cannot rejoin the workforce to begin to sell their stock together. And then you will indeed start to see the momentum trade turn in the risky asset markets that are always, by the way, the very last to turn. There's also some optimism that maybe the Fed's going to be able to come in and cut interest rates by 100 basis points and then stop again. I don't think that that's the case given what we're seeing in the job market.
Yeah, but do you expect in the end then for stock markets to crash like they did in 1929 or with the dot-com crisis where they go down like 70-80%? Nasdaq, is that a likely scenario when things go down?
Anything is possible. And I think that what you're describing is a complete loss of faith in the AI trade. And that's a little bit harder to peg, I think. But there is evidence that even that AI confidence is starting to crack. You're seeing some of the largest players in the Mag 7. You're seeing them start to take on debt and see negative cash flow in order to support the trillions of dollars that are being poured into this area. If you see that corner of the stock market, that pillar of strength really start to crack, then you could talk about a prolonged correction in the stock market. Is it going to be 1929? Is it going to be 2001? If I knew, I wouldn't be talking to you. I'd be off making my trades right now.
Yeah.
So it's very hard to say, but indeed, you're right. Valuations don't matter until they matter. But given where valuations are right now, once we do start to see that momentum trade turn, it's very realistic and reasonable to expect a prolonged sell-off in U.S. stocks.
Yeah, and you were a Fed insider. You worked for the Fed for a long time. What kind of decisions would you take at the moment? Would you indeed also do a big rate cut, or what would be your decision?
So I do again think that it's appropriate because we haven't seen the private sector create jobs since before May of this year, I do think it's appropriate, as they did in September of 2024, to have a catch-up rate cut in September and maybe one of the same magnitude in October, depending on the continued deterioration that we see in the job market. We just had fresh data right before we started filming out of the New York Fed that showed that Americans' perceptions of finding a job if they lose theirs has fallen to the lowest level since the survey's inception in 2013. So the job market is definitely weak, and Americans are very aware of this. And I think the onus is on the Fed to pay more attention to kind of the suffering that's going on out there with hardworking American men and women, as opposed to just crafting policy for that top 1% or top 10% who are going to benefit the most. I would add here, though, before your next question, I think that the fallacy for the stock market is to assume that a little bit of liquidity on the part of the Fed is the same thing as zero interest rate policy and restarting quantitative easing. They're not the same thing. And in order to really bail out truly risky assets with the highest valuations, you need to go right back down to the zero bound and relaunch QE. I don't think that's happening.
No, but do you think it will happen eventually?
It really is going to depend on the philosophy of the individual who is charged with replacing Jay Powell. Because I don't think that decision is going to be in the hands of Jay Powell between now and May of 2026. It really will depend on the philosophy, and there are very few people the administration is considering who would advocate for that policy. Most of the individuals have said, you know what, zero interest rate policy didn't work out very well. Neither did QE. It set off speculation and a credit bubble, and we really shouldn't repeat the sins of the past. That's the thinking right now of the three major frontrunners to replace Powell. So their thinking would have to change dramatically in order for them to advocate for what I think the riskiest speculators are hoping for, which is let's get to ZIRP, let's get to QE, let's get to it right now.
Yeah, but I can imagine if stock markets and things can go, things can turn sour very quickly, especially with this algo trading and all these group dynamics. And if things fall and crash, it can crash really hard. We've seen it already a number of times. So maybe the plunge protection team needs to be called, or I mean, I can imagine for a Fed official to see all these red numbers on their boards and seeing Nasdaq go down with 10% a day. Then at some point they'll probably just want to do something, because otherwise they'll be grilled.
True. They would be, yes, they would be hunted individuals if they didn't, if what you're describing was actually to come to pass. And what you're describing is actually the passive trade falling apart. And that's a whole different situation. And we also have, thanks to Fed policy, we also have the most concentrated consumption in the history of the United States. 49.7% of consumption is attributable to that top 10%. If that top 10% was to see their portfolio melt down and they were to stop spending, that would turn a recession into something deeper than a recession. And that would very, very possibly prompt the Fed to take dramatic, unconventional moves. I will quote Treasury Secretary Scott Bessent, who said, if there are future forays into quantitative easing, they should be coordinated with the federal government and be used under emergency circumstances only. I would hope that would be the case, but hope's not a strategy.
No. And most of my guests actually say that real inflation is higher than reported. Like, for example, I talked to Francis Hunt the other day, and he referred to people collecting Walmart bills, and you would see that the Walmart bill, the average Walmart bill would have has doubled over the past 5 years or so. But if I look at true inflation numbers, like the actual inflation according to Trueflation, which measures actual prices in supermarkets, I believe, it's actually lower than what the government is reporting. What's your view on current inflation, and do you expect it to go up or down in the short run, and then also in the long run? What's your view?
So I think that there are a lot of moving pieces when it comes to inflation. I do believe that Trueflation is the more realistic current look at what's happening with inflation. If you talk about prices having doubled over the past 5 years, absolutely, that includes the pandemic. But what we're seeing right now, what Walmart and Target and the largest essentials retailers are telling us, is If it's not on super discount and it's not groceries or pharmaceuticals, they're not buying it. So that is causing undue pressure on what we call discretionary inflation, which is a lot of what you're seeing reflected in trueflation, on top of the fact that rents are falling. Rents are falling across the board. And we have 80% of the major metropolitan areas in the United States seeing home price declines. And that, of course, is by far the largest input to these inflation metrics. And that's offsetting some of the inflation that US households cannot avoid at the grocery store.
Yeah, maybe also because of tariffs, because everyone's afraid of inflation because of the tariffs. But in the end, it's offset. Then most of it is offset by just weak economic figures and people less able to spend.
Look, you can have tariffs cause all the pressure you want on your margins. You can attempt to pass through price increases. If the merchandise just sits there, you're going to have to discount it. It's just a fact of life. And if Americans are struggling right now between everything we talked about before, the inability to land a job, student loan repayments, credit card delinquencies, I can't pay my car bill, my rent's too high. If they're struggling with that, they're not going to buy something that's an RV or furniture. That's where we've seen the greatest tariff impact. I promise you, these people are not out shopping for a recreational vehicle right now.
Right. And currently we have fiscal dominance. So the US, they have they're big deficits, high debt. Or do you disagree with that? There's no fiscal dominance in your view?
No, I don't think there's fiscal dominance. Fiscal dominance is a situation that feeds upon itself and makes it to where the US government can no longer borrow. So, at last check, there's still quite a few sick banks in Europe, and the Chinese debt market is not really fantastic. Japan is having some serious issues with inflation of its own and with depressed purchasing power. Your situation here is that you cannot look at US fiscal dominance in a vacuum. So and you can't look at US fiscal dominance without incorporating the fact that we have the reserve currency status.
So still the cleanest shirt, basically.
Look, we're spending more than $1 trillion on interest expense, and the government definitely wants borrowing costs to come down, but we continue to have strong treasury auctions. So until we don't, I think having the discussion about fiscal dominance is highly premature.
Okay. Final question, because I know you need to run. Based in Europe, of course, I'm also very much distracted by headlines about France maybe needing a bailout. Most likely, I think it would not be the IMF, but more the ESM, the European Stability Mechanism. But do you think indeed we're going to see over the next few years France being bailed out? And will the euro survive such an event?
Well, we were having the same discussion a few years ago about Italy, and we managed to get through that in one piece. Of course, France is a larger economy, and French banks have a larger footprint on the global stage. So there's a lot more potential for contagion, but certainly the France's fiscal position has been ignored for too long, I think, in the international markets. And given job uncertainty, given youth unemployment, there are a lot of, now you've got the revolving door in French politics. And not being able to hold a government together. The fact that Great Britain is also in an unstable situation at the same time, I think it would take a lot to break the euro. However, what you're describing could be a situation in which the United States is in recession. There's a situation in Great Britain. France is teetering. There's a potential for contagion into other European banking systems. If there was any kind of a domino effect, I think that changes the discussion. If we're talking about France in isolation, I think that France will pull through with the help of the European Union and the stabilizing mechanism there. But if it's a situation that goes beyond European borders, that I think is a game changer.
In a way, it could be Lehman squared, right? It's much bigger than Lehman was.
In a way, it could be. And right now, you don't necessarily have the strength of the Swiss banking system as its own backstop.
No. Great. What's your final takeaway? Some advice you could give to my viewers?
I think now is a good time to be hedged. I don't say that. I mean, I laugh when I say it, but now is definitely a good time to be planning for, what happens if the momentum trade does turn. Gold is not as attractive as it is right now just because central banks are buying it. The uncertainty factor is something that is not unique to the United States. It's also endemic in other areas. So, any way that you can find to be hedged, I think, is reasonable and realistic. I'm much older than you are, so I'm a huge advocate for cash flow strong, high dividend paying stocks. That, you know what, if we're going to have a wild ride in the stock market, at least you can collect some cash along the way and have that be the way you hedge.
Right. Well, very interesting, Danielle. A pleasure and honor to talk to you. Where can people find more about you?
So we have a great following. We publish every trading day of the year, the Daily Feather, DiMartinoBooth.substack.com. Love to have you become part of that investor community. And if you're an institutional investor and you run billions of dollars or millions of dollars or a family office, please come to QI Research. And we've got a fantastic, broad international institutional offering, along with a very lively Bloomberg chat room.
Yeah, and you're also going to speak at the New Orleans investment conference. I saw as the only lady of, I don't know, like 40 guys, and I saw your face too.
There are some other women who are going to be. It's just the photograph, but yes,
Yeah.
yes, that is a constant venue for me, and it's always an interesting and intelligent audience. So I certainly appreciate meeting anybody who's there in New Orleans here in the next few months.
Great, thanks so much, Danielle. Take care, and hopefully I can talk to you again in the future.
Absolutely, take care.
Thank you.